So this week's going to be a really big week from an economic data standpoint, and it really could set up what I think could be a big pain trade going into the end of the year. And I'm going to talk about that in just a minute, but I wanted to just look through really quickly some of the economic developments that we're going to be getting this week. First of all, let's remember September 30th is a quarter end, so there's going to be a lot of things going on from a liquidity standpoint. We're also going to be getting the JOLTS data. We're looking for 7.1 million. Now, this is a very difficult number for analysts to predict, and so it tends to be off the mark with what analysts are looking for, and it can tend to really have big revisions. Then, of course, October 1st, which is Wednesday, we're going to get ADP. We're looking for 50,000 jobs who've been created. For ISM prices, for the ISM manufacturing index, we're looking for a slight improvement to 49 from 48.7. Prices paid, we're looking for basically flat, 63.8 versus 63.7. And then on Friday, we're going to be getting the ISM services data, which is expected to show 51.8 down from 52. And as long as there isn't a government shutdown, we should be getting the BLS job report. We're looking for 50,000 jobs who have been created in September, up from 22. And we're looking for the unemployment rate to remain unchanged at 4.3%. Average hourly earnings at 0.3%, month over month 3.7% year over year. We're looking for the work week to remain unchanged at 34.2. So this is a very big week from that standpoint. You can see why this is setting up to be that very big week. But before we get into more stuff, just please remember to subscribe to this channel, like this video, share it with your friends. I need your help to continue to grow. What we're looking at here is this first set of data that I wanted to really take a look at. Now, this isn't going to be so important for the pain trade, but I think this really just kind of sets up where we are in the labor market. So this is the JOLTS in light blue, and you have the Indeed job posting in the darker blue. And what this shows is that the Indeed job postings have continually declined over the last several months, and we really haven't seen. It looked like maybe over the summer we were starting to see some signs of stabilization, and that just hasn't actually held as we continue to go forward. And you can see that in September it's been particularly bad. We actually saw the Indeed job posting fall to a new low, and this is continuing to suggest basically that the JOLTS, the job openings numbers, isn't stabilizing, and we're likely to see that continue to fall in the future. What's really developed over the last several weeks that I find really interesting and really starts setting up the pain trade is the city surprise index. You can see 10-year treasury rate kind of trades along with changes in the economic surprise index. And I think this is really important because if you notice, really since let's call it, June, the economic surprise index has actually been steadily trending higher. And while we started to come down in August into September, you can see there's been a big shift in this index over the last couple of weeks. And you've started to see 10-year rates actually begin to go higher since the Fed not only has cut, but also since the surprise index has begun to move up. This is really where the pain trade develops, right? Because the city surprise index is telling us maybe that economic growth is actually improving, which is kind of surprising. I don't think a lot of people were thinking that they were going to see the economy really accelerate into the end of the year, because a lot of people have been hearing about the weak labor market. We can clearly see job growth is expected to be low. Job postings has really declined. And we're not really thinking that we're entering a period of reacceleration in the economy. But yet that's what the economic surprise index is kind of telling us. And it could be indicating not only that the economy could be doing better and improving, but it could also be telling us that 10-year rates are going to be going higher, because if we look at this index over time and we look at it more recently, you can see it kind of, the 10-year rate kind of goes with the flow of the economic surprise index. And it's not just the 10-year rate that does that, but it's also the dollar. And you can see the dollar has fallen pretty dramatically more recently, but all of a sudden, you start getting the surprise index moving higher, you start getting 10-year rates moving higher, you could really start getting the dollar moving higher. And this is where the pain trade could live. It could live in the area of higher rates at the end of the curve, stronger dollar. And that's not really the trade that I think a lot of people are set up for or thinking about when it comes to what could happen over the next couple of months as we go into year end. The more interestingly is that we've seen the same thing really happening in the GDP Now data. That's also showing us that real economic growth has really started to accelerate again in the third quarter. And in fact, when we look at this data, GDP GDP now is anticipating real GDP growth in the third quarter of about 3.9%. When you take that number and you add it to the PCE number, which is technically like a deflator, it gives you a sense of where nominal growth is. And nominal growth is actually accelerating as well. And it's suggesting that nominal growth could actually be somewhere around 6.2% on a seasonally adjusted annualized rate. And that's a really fast growth rate. In fact, it kind of goes more along with where we've been more recently before we had that big plunge in activity in February through April. This is really back more towards the upper end of the trading range that we've been in for economic growth. And you can really see the curvature towards it, with it really accelerating and moving up. And believe it or not, the jobs report actually plays a really important role in all of this, because it has a very important series in it that doesn't get a lot of attention but could actually be just as important as all these other data points. It's called the Index of Aggregate Weekly Payrolls. And when you take that number and you put it on a year-over-year basis, and what you see is that this Index of Aggregate Payrolls actually tracks nominal GDP incredibly closely. And this is looking at it purely on a year-over-year basis, so we're not looking at an annualized adjusted rate like GDP now does. But right now we're purely looking at this just on a year-over-year basis. And what the aggregate index has really been telling us is that, yes, the economy has really been slowing down. That's the dark blue line. And in fact, it was telling us that in August, nominal GDP growth was probably only around 4.4% or so. You can see that in June, the nominal number was around 4.6% for the second quarter. And that's important, because now all of a sudden, if we are getting a reacceleration in the economy, as GDP now is telling us, and as the City Surprise Index is telling us, we really should see that number show up in the job report. And we'll know by looking at this index. That's one way to know. The other way to know will be if wages were strong and if we saw work weeks go up in hours. That will give us a sense also whether or not there's a pickup in growth and a reacceleration in the economy. Because if it is the case, acceleration in the economy, one would expect that this annualized that this year-over-year change in aggregate weekly payrolls would also begin to show signs of acceleration and begin to move up as well. And again, that kind of sets up that pain trade, because if growth is going to be stronger going into the end of the year than what it was expected to be based on some of the revisions we were getting out of the labor market, then that really means that rates on the back of the curve are probably too low, and it probably means that we should really see bear steepening. And I'm going to show you some good examples of this. So this is the 30-year minus the 12-month Treasury bill. I'm using that because it gives us a little bit more data to work with. And what it's showing us here is that, there are times where the curve is steepening in a way where you're getting the front of the curve coming down because the Fed is cutting rates, in this case cutting rates into recession. And in this case, there was a mild uptick in the curve. Also notice this time, this is a 2-year break-even inflation expectation. That was also rising during that time. Now we had also another interesting period of time in here where you also had again, the front of the curve coming down really sharply. This was during the GFC, and at the same time you could see the 30-year rate really rising. That's what gave us that second leg of the steepening of the curve, and that was due to, again, inflation expectations rising, and that was a bear steepener. Again, when we look during this period of time, Fed wasn't really doing anything. Interest rates were fairly flat. You can see as well with this arrow here pointing to the bear steepener as well, where you had 30-year rates rising. That was driving the steepening of the curve. 2-year inflation expectations rising. Here was another such example in 2017 into 18. Fed was starting to raise rates, but you also saw the same thing happening where before you really started to see the 12-month Treasury going up, which should have led to the curve contracting, you actually saw a little blip where the 30-year rate was actually rising a little bit faster, moving away from the 1-year, allowing the curve to expand. And that, again, was because we had some inflation expectations rising. Same thing happened after COVID. The Fed basically had rates at zero and wasn't doing anything, but yet the market was anticipating and pushing inflation expectations higher. 30-year rate basically started to go up, and that led to a bear steepener. And it looks like you could be setting up a similar type of function right now, where you've been seeing 2-year inflation break-evens move up, and you're now seeing the front of the curve moving down. it could be setting up a scenario like you saw in 2007, 2008, 2009, where the back of the curve actually rose as inflation expectations rose, even as the Fed was cutting. And it's certainly a possible scenario. And certainly, if we're looking at a scenario where the economy may be accelerating, that would be the biggest pain trade of all at this point. And you can see it a little bit more clearly when we look at this chart here, how more recently we've started to see signs since the end of last year, 30-year rate moving up. But notice right in here, the 30-year rate's came down really hard, and now it's starting to show signs of coming back up. Here's your 12-month Treasury, also moving up a little bit as well. But you would think that if we started to see inflation expectations really begin to rise, that you would begin to really see the 30-year rise as well. And that's likely due because the economy is doing much better than what's expected. And it really plays into also what's happening potentially in the dollar. And in fact, I think I was talking about this a lot in the member area, because what we've seen take place over the last couple of weeks is you've seen, spreads, especially when it comes to U.S. rates and Japanese rates. If you look at this more recently, you've been seeing basically this case where you've been seeing, rates, the spread between a U.S. and a Japanese 5-year really collapse. But yet you really haven't seen the Japanese yen strengthen at all. In fact, it's actually been in a weakening pattern. And that's really telling, because we have a clear sign from the BOJ that they're likely to raise rates. You had 2 people dissent in that last BOJ meeting, and the Fed is obviously committed to probably cutting rates a little bit more this year and into next. And at the same time, you've seen this spread really begin to move down. And so that really gives us two messages, right? Either the market doesn't believe that the BOJ is going to raise rates, or the market's telling us that rates in the US are too low and they're poised to rise. Here it also is when you look at the Japanese US 10-year minus the Japanese 10-year, same setup. So I think there's a very good chance that going into year end, you're setting up here where you could see the dollar really begin to strengthen. Here's your potential double bottom that's formed in it. 3 higher lows, while you've had actually 1 lower low equal to the previous low. So you could be looking at a scenario where the dollar is starting to put in a bottom. You could be looking at a scenario where you're looking at the yen moving back up towards this 151 area. You could be even looking at a scenario now that the euro has broken down below this trend line, and even starting to show signs of breaking down on the RSI, where the euro maybe is coming back down to 114. We could be looking at a scenario where the Canadian dollar is actually now going to really start weakening materially versus the US dollar. In fact, you had a triple bottom in place on the Canadian dollar, and you had what looked like a head and shoulders pattern forming. And when head and shoulders patterns don't break down, they actually serve as continuation patterns. And so in this case, the continuation pattern is higher. And there's a possibility, like I said, we could be heading back towards 141 or so on the USD CAD. And that's important to keep an eye on. There was also, interestingly, a time, which I'll just mention, where the USD CAD used to trade really closely with the VIX, and I'll change this into black so you can see it better. But you can clearly see there was a time where they traded pretty well together, and that's dissipated a little bit in more recent months. It certainly wasn't the case during this period of time, and it certainly wasn't the case when we spiked. It looks like as we came down, we were seeing the VIX coming down as well as the dollar weakened. And you can see there's a little bit of the same ebb and flow, but it's not really as strong of a relationship as it used to be. But something to keep an eye on, especially if you start seeing the Canadian dollar weakening versus the US dollar. Maybe you start seeing volatility in the equity market begin to increase as well. And just to finish up, we could look at the British pound. That also has been showing signs of weakening versus the dollar. And they have a whole bunch of other things going on over there that are completely separate from monetary policy and interest rate differentials. And so when you look at, again, the 10-year here, it looks like we've held on to some key areas of support around 4%. It looks like the RSI is fairly low. It looks like we're probably maybe breaking, a downtrend in the 10-year rate, and we're getting ready to potentially really see this thing move up and and move up and break out. Even when you look at the 30-year, we've kind of bounced back as well. Potentially, we just have to wait and see if we can get above this 480 area. If that happens, I think you can start moving back to 5%. And you know, if you look at the 30 U.S. 10-year minus the 2-year, that also has been showing signs of trying to get some motion going. It's been very slow going, but again, I think there's a good chance that you could see the back of the curve really begin to steepen, especially if we get, you know, pretty decent economic data this week that kind of verifies and confirms everything we've been seeing up until this point, that maybe suggests the economy is doing a little bit better than everyone expected. Anyway, please remember to subscribe to this channel, like this video, share with your friends, and we'll see you again soon. Bye.